All right, let's jump right in. Welcome to this explainer. Today, we're taking a deep dive into the absolute foundational concepts of business by breaking down Chapter 1 of Brigham and Houston's Fundamentals of Financial Management. Now, if you're aiming to navigate the fast-paced corporate world, especially within our dynamic Philippine business landscape, you really need to understand the structural DNA of how businesses operate, how they grow, and ultimately, how they're valued. So let's get into it.
Here's our quick roadmap for today. First, what is financial management? Second, forms of business organization. Third, intrinsic value versus market price. Fourth, agency conflicts in society. And finally, number 5, careers and finance trivia.
Okay, Section 1. What is financial management? The ultimate goal here? Maximizing wealth. To frame our discussion, I want you to picture the bustling streets of Manila for a second. Have you ever stopped and wondered why a local sari-sari store owner almost always stays a sole proprietor? While giants, like Jollibee or SM Prime, why did they have to evolve into these massive corporations? Well, it really boils down to scale, risk, and capital. Because as businesses grow, their financial management needs get, honestly, incredibly complex.
Let's actually map out the chain of command in a typical large corporate office. Picture one you'd see right in the middle of the BGC financial district. At the very top, elected by the shareholders, is the board of directors. They're the ones overseeing the chief executive officer, or CEO. Now, reporting directly to the CEO, you typically have two key figures. You've got the chief operating officer, handling marketing, production, and HR, and right alongside them, the chief financial officer. The CFO is literally the architect of the firm's financial health. We're talking accounting, treasury, credit, legal, capital, budgeting, and investor relations. It's a massive job, and understanding this hierarchy is absolutely crucial for our next topic.
Moving right along to Section 2, Forms of Business Organization. It's all about choosing the right structure.
Okay, so on one side of the spectrum, we have proprietorships and partnerships. Think of your favorite local carinderia in Quezon City, or maybe a small, tight-knit accounting firm set up by 3 CPA friends in Makati. The advantages here are great. They're super easy to form, they have very few government regulations, and best of all, there are no corporate income taxes. But the disadvantages? Well, it is very difficult to raise large amounts of capital, the business's life is usually limited to the life of the founders, and they carry unlimited personal liability. Yikes. Now on the other side, we have corporations. Think of those massive PSE-listed giants like Ayala Land or San Miguel. They totally solve the capital and lifespan issues, and they offer limited liability, meaning the owners only lose what they actually invested. The catch? They face way more complex regulations and double taxation.
All right, time for a quick quiz. Let's say an entrepreneur, we'll call her Mary Grace Piatos, wants to expand her super successful single carinderia into 10 branches nationwide. To do this, she needs 20 million pesos in capital. But crucially, she absolutely does not want to lose her personal house if the expansion fails. So which business structure should she transition to? Pause this explainer right now and comment your answer. Okay, if you said corporation, you hit the nail on the head. The limited liability and the sheer ease of raising capital make it really the only logical choice for that kind of massive scaling.
Section 3. Intrinsic value versus market price. Basically, reality versus hype.
Let's break down how this valuation actually works in the real world. On the left side here, we have true investor cash flows and true risk. These are based on the actual, fundamental, on-the-ground reality of the company. This is what determines a stock's intrinsic value. It's very much a long-run concept. But over on the right side, we have perceived cash flows and perceived risk. Imagine a hypothetical tech startup that just listed on the Philippine Stock Exchange. Wild hype on social media might falsely inflate investors' perceptions, driving up the stock's market price in the short run, regardless of the actual financials.
And that brings us to this absolutely crucial concept right here, market equilibrium. This happens when a stock's market price perfectly aligns with its true intrinsic value. The golden rule for management is that they should ideally avoid actions that reduce intrinsic value, even if those decisions might artificially pump up the stock price in the short term. Because at the end of the day, real wealth is built on true value, not perceived hype.
All right, Section 4. Agency conflicts and society. How do we align everyone's interests?
So, as a corporation gets bigger, the folks who own it are usually no longer the same folks running it day to day. And, as you might guess, that creates some friction. First up, we have stockholder versus manager conflicts. Managers are naturally inclined to act in their own best interests, right? Which might mean demanding lavish office perks or building a personal corporate empire rather than actually maximizing shareholder wealth. Second, we have stockholder versus debt holder conflicts. Stockholders generally love risk. Why? Because if a high-risk real estate project succeeds, they get all the massive upside. But debt holders, like those local commercial banks who lent the company money, they absolutely hate risk. They only receive fixed bond payments, so they just want the company to play it incredibly safe and guarantee repayment. Because of this, debt holders will actually attempt to protect themselves by writing super strict covenants into their bond agreements to constrain any risky managerial actions and limit the company from taking on more debt.
So, how do stockholders actually make sure managers are doing their jobs and maximizing the stock's intrinsic value? Well, they use structural carrots and sticks. They align behavior through carefully crafted compensation packages, like, say, giving executives stock options so they literally only get rich if the shareholders get rich. They also use direct intervention, the very real threat of just firing underperforming managers, and the overarching, scary threat of a hostile takeover by another firm if the stock price drops way too low due to bad management.
Let's do another quick check-in here. Think about this scenario. If a company decides to secretly cut its factory safety standards just to boost its profit margins for this current quarter, does that increase its long-term intrinsic value, or does it just create a short-term illusion of success? What do you think? Well, sure, the current stock price might bump up slightly due to those artificially higher reported profits, but the true risk of catastrophic lawsuits, labor strikes, or government shutdowns, that skyrockets. Therefore, the true intrinsic value actually plummets over the long run.
Which directly leads us into a super vital concept. Corporate social responsibility, or CSR, is absolutely not inconsistent with maximizing long-term shareholder value. In fact, they go hand in hand. In the Philippine context, investing in environmental sustainability, ethical labor practices, and community development completely avoids devastating regulatory fines and builds an incredibly resilient, trusted brand. Socially responsible decisions really are financially responsible decisions when you look at the long run. Okay, rounding the corner into Section 5, Careers and Finance Trivia. Let's talk opportunities. Mastering all these foundational principles, it literally opens doors to some of the most dynamic, high-paying careers out there. As outlined by the sources, you could dive headfirst into investment banking, helping massive corporations raise capital. You could pursue actuarial careers, dealing with super complex risk calculation, or manage vast sums of wealth in portfolio management. The deep analytical skills you develop are equally prized in quantitative analysis, trading, and comprehensive financial planning and analysis within major corporations. The opportunities really are vast.
And just for a bit of fun historical trivia to wrap up our content today, did you know that the complex world of modern corporate finance, issuing shares, paying dividends, limiting liability, kicked off way back in 1602? It started with the Dutch East India Company, or the VOC. They were literally the very first entity to issue shares to the public to fund massive global voyages, effectively birthing the whole modern corporate structure and equity trading system we've been talking about today.
So, I want to leave you with this final thought today. As you continue your studies and eventually step out into leadership roles within the Philippine business world, what kind of financial architect are you going to be? Will you get distracted chasing short-term market hype, or will you use these tools to build true, lasting, intrinsic value? Thank you so much for joining me on this explainer. Be sure to review these Chapter 1 slides carefully as you prepare for your upcoming assessments and keep seeking that long-term value.